Last episode changed the way many of you think about time in trading. Today, we take it further. Same concept, different market, and the numbers are just as powerful. Because yes, the DR trading strategy works on crypto, and we are actively collecting data for it. If you haven't watched episode 14 yet, go back and watch it first. In front of us last Tuesday on Ethereum versus the US dollar. The regular defining range has just completed its first hour, 10:30 a.m. Levels are locked in. You already know the preparation routine. 1 hour transition window before the session. Previous DR levels from the last 3 weeks highlighted. We will come back to those. Let's read the models. What do you see? A DR upside model off the table, a DR downside model off the table. This constellation should be immediately readable to anyone who has followed this series. What remains? A DR range expansion model. All three DR boxes are expanding in size. That gives us immediate early targets, one standard deviation to the upside and one to the downside. And with that, trumpet-like price action becomes a real possibility. But before we go any further, two things that cannot be ignored. First, there is no confirmation to either side yet. Second, the DR box closed green. That gives us roughly a 70% probability of seeing a long confirmation. A bullish outcome like this becomes very possible. But what if price wants to play both sides? What barriers exist in either direction? We don't have any confirmation yet, so let's toggle on the previous DR levels and find possible barriers. For a long confirmation, price needs to break cleanly above this darker shaded area at the top of the range. We've already seen rejections from that area. Now the short side. What's standing between current price and a high probability short setup? I'll give you a hint. Look at the 9:30 a.m. opening candle. Ask yourself, what caused that explosive move to the upside that took out the overnight session highs? It's the aftermarket session mid rejected, precisely. One of the most critical levels in the entire DR-IDR intraday cycle, especially inside a range expansion model. The aftermarket session mid combined with the current DR session lows creates a massive barrier for price. That zone needs to be broken clearly before shorts become a high probability trade for this session. Until that level breaks, no short engagement, no guessing, no exceptions. And then, not even 30 minutes later, the 10:55 a.m. candle closes below the defining range on the 5-minute time frame. Short confirmed. Not only does the one standard deviation level immediately become a target, the aftermarket DR lows lining up in the same area should catch your eye instantly. But here's the real question. Where do you enter? And is it even possible to target beyond one standard deviation? Let's find out, using the exact same approach as last episode. The short confirmation happened within the first 30 minutes after the DR box formed. We're going to pull historical data for exactly this scenario and see what Ethereum has done most frequently under these conditions. This data covers only confirmations within the first 30 minutes. Nothing after 11 a.m. applies here. We switch to the database Ethereum, regular DR session Tuesday. Short confirmation in the first 30 minutes. The first number we see, DR true percentage at 64%. Lower than last episode, but stay with me, because this is where it gets interesting. Let's focus on maximum retracement time. Same concept as episode 14. If you're feeling lost, go back and rewatch. What does the data show? When price confirmed short within the first 30 minutes, the maximum retracement back into the range happened very early, the majority of the time. And there is one window that stands out completely. Between 11:45 a.m. and 12 p.m., not a single maximum retracement for the session. In the entire dataset. Never, not once. It gives us something extremely valuable, a cutoff point. After 11:45 a.m., we are no longer interested in new entries. The data says so. Let me show you exactly why. The DR true percentage for the full dataset sits at 64%, but filter only for maximum retracements that happened before 11:45 a.m. That number jumps to 83%. 83%. That means when the maximum retracement occurred before 11:45 a.m., Only 17% of the time did price close above the defining range for the rest of the session. Now filter for maximum retracements after 11:45 a.m. 54%, almost 50-50. That's not a trading edge, that's a coin flip. So the conclusion is simple. Entries before 11:45 a.m. carry a fundamentally different probability than entries after. The data doesn't suggest this, the data proves it. Visually on the chart, the black line sits at 11:45 a.m. Everything to the left is where the edge lives. Everything to the right is where confidence disappears. And if you happen to be in a trade before 11:45 a.m., you can now assume with almost 50% probability that this is the maximum retracement for the session. If a new maximum retracement follows during the session after your entry before 11:45 a.m., why would it be a higher risk trade? Because data tells us that there is a 46% probability that the DR session will turn into a false session and close above the high. That changes everything about how you manage your position. Now let's look at where price retraced in the 83% of true sessions. 3 retracement zones stand out from the data. The first and most frequent sits from plus 0.09 down to minus 0.2. This is where maximum retracements happened most often, right at the low of the defining range, aligning with the aftermarket DR mid. The second zone, minus 0.41 to minus 0.6. Around 30% of sessions saw maximum retracements reach deeper than that. One critical note, from minus 0.6 all the way up to the IDR high at minus 1, not a single maximum retracement for the session, ever, in the entire dataset. That is a stop-loss placement gift. The third zone, minus 1.01 to minus 1.2. A deeper retracement area that appeared with enough frequency to be considered. 3 zones, 2 bullets. We will get to that. First, let's look for targets. Remember the one standard deviation level from the range expansion model? That's only the beginning. Price reached 1.2 to 1.29 standard deviations in 85% of true sessions. And the most frequent extension level, 2.1 to 2.19 standard deviations. That's not random. The algorithm seeks this level more consistently than any other in the specific setup. 1.9 to 2.19 standard deviations were historically reached 70 to 75% of the time when the maximum retracement occurred before 11:45 a.m. These numbers change how you think about targets. Now back to the 3 zones. 2 bullets problem. You have 3 high probability retracement areas and realistically 2 entries. What do you do? Option 1. Let the chart decide for you. Look at the DR levels overlapping around the 3rd retracement zone. The darker shaded area just below creates a natural barrier. Focus your 2 bullets on the 1st and 2nd zones where data concentration is highest. Option 2. Risk management math. Take 1 R in the 1st zone, the highest frequency area. If it gets stopped out, take the 2nd and 3rd entries at half risk each. One good trade from those 2 will cover the earlier loss and leave you positive. The key point, don't fear the entry. You've already done the work. You know the probabilities. The only job left is execution. And if price extends to targets before retracing, there is nothing to trade. That's acceptable. You don't chase. 15 minutes into the session, a bullish candle forms. Most traders would hesitate here, step back and wait for clarity. But clarity already exists for anyone who did the preparation. You know the retracement zones, you know the time window, you know the targets. A bullish candle inside your first retracement area isn't confusion. It's an entry signal. You take the close of the 5-minute candle, or even prior to the close. No matter which target you aimed for, one standard deviation or the deeper extensions, the risk to reward on this trade is exceptional. And then, exactly as the data suggested, price finds its maximum retracement for the session before 11:45 a.m. inside the first retracement zone, and then expands. Both sides of the market played. Trumpet price action delivered, exactly the scenario we mapped out before confirmation ever happened. Another session where historical data aligned with present price action with unmatched precision. And the time aspect alone, knowing where the edge disappears, is worth more than any indicator on any chart. Data cannot be manipulated. It is the most honest input you can bring to any trading decision. Without it, you are guessing. With it, you are calculating. That is the difference. If you took value from this episode, leave a like. It helps more traders find this series, and I'll see you in the next one.
We're gonna take on the world.